I'm Jared Johnson, and on this episode of the Stock Market Playbook, we've got Adam Butler, and he has got some excellent points of view. I loved our discussion about how the market is changing, what could happen with another crash, and everything in the middle. And also some interesting tips on how he's using AI in his investing process. You're going to love this episode. Give it a look. Take it away, Adam. Okay, Adam, thanks for joining us on the podcast. Happy to have you here.
Jared, you're a gentleman. Thanks for having me on.
Absolutely. So we were chatting just before we started recording, and it sounds like you're in a more beautiful place than, I don't know, 99% of the rest of the world. Is that safe to say?
Well, just to balancing off, Jared, I grew up in a place called Newfoundland, which is a relatively barren rock on the east coast of Canada. It's an island, right out in the North Atlantic. And I used to, in early to mid-June, watch icebergs float by from my window as I looked down to the harbor. We had summer between 2 and 6 weeks of sunshine a year, and the rest is what we used to call RDF, rain, drizzle, fog. And snow used to, we used to get snowstorms well into June. That wasn't unusual. So, when I was growing up, I dreamed of living somewhere in the tropics. I remember I used to write letters to these. My parents subscribed to Travel and Leisure magazine. In the back, they used to have these advertisements for tropical resorts in like Fiji and Tahiti and Moorea and stuff. And I used to write these handwritten letters and send them to the resorts and ask them to send me their brochures. We're interested in maybe coming. Send me brochures to see if we want to come. And I used to plaster the brochures up on my wall to help get me through the winter. So living in the tropics is nice. Many reasons it's a dream come true. Midsummer, it is definitely hot as hell. And it's much more gratifying to be here when everyone is cold, and in the winter when the humidity is not nearly so great as it is right now, but I have no complaints in general.
Man. Well, paradise, it can't be perfect 100% of the time. Summers
right.
do get, the humidity creeps up. I actually took my family. We, like a week ago, got back from Alaska. And so, in the vicinity as far as, longitude, latitude, whatever of Newfoundland probably. And so beautiful up there. But we were there at the end of June, and I think I was able to take my coat off once or twice, and
right.
So beautiful. But and I just kept asking people everywhere we went. I said, "Are you from here?" And they'd say, "Yeah, I'm born and raised in Alaska." And I'd always say, "How's the other 9 or 10 months of the year?" And they're like, "Oh yeah, it's bad. It's bad."
Yeah.
But so
cold, dark,
but hey, we get used to it, I guess. But oh, very cool. Very cool. Well, we're happy to have you on the podcast today. I think there's a lot of stuff going on in the markets, and there's a lot of different ways to approach what is going on in the markets.
Mm-hmm.
And I think you have a pretty cool approach that you incorporate as far as how you invest and how you position yourself. So I just want to get into all of it, but give my listeners just a quick, you're Adam Butler, living in paradise, running some money. Give us a little background here.
You bet. So I'm the Chief Investment Officer of Resolve Asset Management. We run primarily systematic managed futures strategies. Systematic just means that all our decision making is through data and formulas and math. We are not a high frequency shop, so we trade daily based on signals that sort of bubble up over the last few weeks, months, perhaps years. We trade across, call it 60 to 80 markets, different global equity indices, bond indices, commodities, and currencies. While I do, I can't help but be passionate and interested in what's going on in the global economy and form my own narratives and my own views. They don't really inform the day-to-day positioning the portfolios. That is largely left to algorithms. And we can get into why, because I didn't always think like that. I didn't always believe that leaving things to algorithms was a useful, perhaps the most useful way for me to invest. But that's the way it is now. But I mean, you don't get into this business usually because you like statistics. You get into it because you like investing and the ever evolving puzzle. And so, I don't ignore it, but it doesn't dominate my investment views.
It's interesting because, I think a lot of the most successful investors, I mean, the good old Oracle of Omaha would probably, say the same thing, right? Warren Buffett says, I find good businesses that are undervalued, that are making a lot of money, and I buy them and I hold on to them, right? And we never know what's going to happen, but it's funny because I think really that whole point of view of where everything is going to go is really more for kind of like CNBC. It's more for let's give our watchers and our viewers something to chew on and digest. I was literally just having this conversation this morning with a trading group, and I said, guys, I wish I had more of like a roadmap that I could share with everybody, but I don't. Here's the things I look for, and I just want to make money on them, and I don't know or care what's going to happen in 3 or 6 or 12 months, and I don't think anyone else does either. So I hate to break it to you, and that's a story nobody wants to hear, but it's the truest one. I have to think. And when it comes down to it, investors and people that are putting money with you don't care. They want to make money, right? And nobody knows what's going to happen in 12 months. And so it's interesting you bring that up, because I was literally just having this conversation a few hours ago. But we can all have our thoughts and we can all have the things that we're looking at. But I certainly am interested in approaches, and I'm interested in hearing what people are doing. So even if you don't have a forecast that's end of year, end of 2027, what gets you from point A to point B? You said you're very systematic, and are these automated investments, or are the algorithms indicating and they're manually executed? How do you guys go about this?
We run about 250 models for each market, and most of our strategies trade call it 60 markets. We do have some strategies that are sleeves of other strategies that trade some less liquid markets, but primarily we're focused on sort of the 50 to 60 most liquid ones, and they're informed. I like to invoke the metaphor of these large array telescopes, right? Like the Atacama telescope in the mountains in I think it's Chile, but it could be Peru. So you've got these, many hundreds of dishes all scattered around across several kilometers, and they're all kind of pointed in the same direction. It's similar concept to your eyes, right? Your two eyes they're looking at the same thing, but from slightly different angle, and so you're able to get a better resolution. You get depth perception, right? So now expand that to hundreds of different eyes scattered across several kilometers, and then not just like a wide distance apart, but also looking at the world through a wide spectrum within the electromagnetic spectrum, right? So ultraviolet, X-ray, infrared, et cetera. So you've got all these different cuts looking at the markets, all with slightly different views, looking at it with slightly different perspectives of information, and then aggregating up to a final signal for each of the different markets. And that can be informed by, the kind of canonical managed futures signal is the trend positive, right? So has this market been generally rising for the past few months or maybe a year, or has it been generally falling? If it's been rising, you want to kind of be long. If it's been falling, you want to generally be short. But then there's also information in the term structure, right? Is the futures market in contango or backwardation? What does that imply about current supply demand dynamics versus supply dynamics down the road? We've got different buyers and sellers at different levels of urgency in their purchasing and buying for things that will require those commodities further down the road. All of that shows up in the term structure of the futures markets that informs whether we want to be long or short. And then there's more kind of mathematical or statistical oriented signals based on the third and fourth moments of return distributions and all kinds of stuff like that. But really, it's just about looking at each market from a wide variety of different angles, and then finding the best ways to converge on a final signal from that. And then there's risk layers and portfolio maximizing diversification type layers and all that kind of stuff that run on top. But yeah, I mean, our positioning from day to day is largely based on the premise that the markets themselves are the most important source of information. And so they aggregate not just the feelings and the curiosities of all investors, but actually where they feel confident putting their money from day to day. And, from that perspective, we feel like it's the highest confidence, closest to the metal source of information and insights about where we want to invest.
That is such a good, I think, reminder for probably everybody to hear and remember and really internalize, because, obviously there's so many approaches to trading and investing. As you've said, it sounds like you guys have quite a sophisticated approach and how you disseminate the information and execute trades. But it comes down to something very fundamental, which is, does the market react positively to good news? Does it not react at all? Or does it react negatively to good news? And vice versa, right? It's kind of this, where is the flow going? And what is the reaction in the market to whatever is happening? And that tells us so much. I would say that of all the guests we've had on the podcast, that's probably the only thing that everyone seems to kind of have that common thread. Everybody has their different approaches and they vary wildly. I don't hear the same, approach or strategy from anybody that we've had on the show, but what is the market doing? How is it reacting to whatever is happening right now? Seems to be a very common thread. And I think it's both so important and so overlooked by so many, right? And especially in this age of such easily access technology, and we want to make things so complex, and it's like, okay, and you can, but what is the market? What is the reaction, right?
Yeah.
Can anything go up anymore? Can it stop going down? Can it start to break out? So that's very interesting that with your guys' algorithms and your various approaches there, that it comes to a very basic, important principle in investing. Now, so in so doing, where do you guys find yourself? Are you all along the spectrum of long-term, short-term, everything in the middle? Do you tend to go
our
one
forecast
direction or
horizon
another?
tends to be sort of over the next, call it 5 to 20 days, depending on the different model and source of information. It tends to manifest at that horizon, and we've tested a wide variety of other horizons. If you want to go shorter, you're just competing with a very different class of investor in the intraday space, and obviously as you get shorter and shorter, the infrastructure that's required in order to compete at that level gets more and more expensive and sophisticated. And then once you push out past like a few weeks into months, now you're competing more in the fundamental discretionary macro space, which I spent a lot of my early career trying to compete in. And, I think that's a very difficult time horizon to compete in and to deliver strong performance in consistently, because you're into horizons that exhibit a lot of reflexivity. And there are a variety of agents that have the ability to completely derail whatever narratives you have built up over time through fundamentals and introspection and careful analysis. There's always very large agents that may observe the prevailing economic trends or fundamentals and not like where those are going, or they may interfere with what their political objectives are and decide to step in and change the game entirely. There are obviously some pivotal moments that we could point to where government stepped in and did that. I think the recent energy Strait of Hormuz, crisis is also elucidating. But the point is, there's very large actors that have the capacity to change things in fundamental ways, and the market is only left to its own devices so long as it serves the purpose of its masters, which ultimately are the world's governments and central banks. So just trying to account for all the different objectives of the participants and how different participants might choose to change the rules of the game. I have always found that to be the hardest element of discretionary investing.
That is tough because like you said, you can be right about everything, but there could be a 50% drawdown on the way to being right, and those are expensive, and those are not fun to sit through, and those are those are tricky, and so that's interesting. And in my own approach and how we manage the fund is everything is kind of about we're a little longer term, about 2 to 6 weeks, so we're right in the same
right.
Who has time to sit around forever and be in trades, So I definitely like that. And, every time something happens, certainly, we see a big move in gold, that last big move in gold we had. And so then all the gold bugs and the big macro guys say, we knew it. We just had to sit in it for 20 years. And it's like, well, that's a long time. Yeah. There are things that are happening out there in the more shorter term basis. So you guys, is your focus mostly in futures? Is that everything, or is that the majority? Are we looking at single names, stocks, equities at all?
Well, I'll give you a little background actually, because I think it's motivating. We spent, I'm going to call it the first 7 or 8 years after forming Resolve, really focused on alpha generation, right? And the message to clients was always, why do you care what the market's doing? You want strong, robust, consistent, sustainable, risk-adjusted returns at your target level of risk. And this was always an uphill battle, but we were convinced that one day we were going to find the one client that wasn't going to care what the market was doing, and would be able to ride the vagaries of the market, attend dinner parties, attend cocktail parties, and not be ever jealous or celebratory about his investment portfolio relative to the other people at the dinner party, was happy to not participate in conversations about the latest hot trends or stocks or what have you. And, after 7 or 8 years of trying hard to find that perfect client, and there are some out there, right? But trying to find sort of product market fit for that client is just really challenging. And so we pivoted, we finally sort of took the medicine and we said, okay, we're never going to really be able to scale this business by trying to force clients to be who they don't want to be. So clients want to own the market. They want to own their stocks and bonds. And I get it, because the market has treated them really, really well, right?
Sure.
It didn't treat European investors very well. It didn't treat emerging market investors very well, or Chinese investors very well. And, for 35 years, it didn't treat Japanese investors very well. But if you're an American who's focused primarily on U.S. equities, then the U.S. equity market has treated you really, really well. And so, you don't want to sell some of your stocks or some of your bonds in order to buy an alternative, right? That is just a trade you don't want to make. So we said, okay, well, look, we manage strategies that are actually really capital efficient. So if I want, with a futures market, to get a 100% exposure to the S&P 500, I want to get $1 million exposure to the S&P 500. I've only got to put $50,000 on deposit at Interactive Brokers to get $1 million exposure to the S&P 500. Okay, and that means it's the same thing with gold or treasury bond futures or, WTI crude oil. Maybe you don't have to put $50,000 down. Maybe you got to put, $7,000 down for treasury bonds, or maybe you got to put $13,000 down for Brent crude or something like that, right? But it's a small amount relative to the total exposure that you want to target, right?
Sure.
So we can take the rest of those funds and invest them in an S&P 500 index fund, right? So you're going to get 100% exposure to the S&P 500, and we're going to borrow against that S&P 500 index fund in order to put all of these other futures positions on. We don't need to borrow very much. We need to borrow kind of $15 to $20 of that S&P 500 fund exposure in order to run a very robust risk, strategy or program at the right level of risk to diversify this core S&P 500 cash funded portfolio, right? So now you don't need to sell those sacred equities. You could hold 100% in those sacred equities and then also get this diversified exposure on top. And, we stacked on top diversified strategies that over the long term have basically zero correlation to US equities. We also launched then to stack on top of bonds. So we've got managed futures trend, we've got managed futures carry, we've got merger arbitrage, we've got another strategy that stacks gold and Bitcoin in sort of equal risk on top of the S&P 500. So you get your S&P 500 and you can also get an allocation to gold and Bitcoin at the same time, right? So this realization was the idea that really took off. So now we run about just shy of $1.5 billion in these return stacked strategies using US listed, very liquid ETFs. And obviously this is an idea whose time has come. But it took us a long time to recognize that we were fighting an uphill battle and to give the investors what they want.
It is tough. It is tough. Even though we know that there sometimes can be a better way. We have clients at the end of the day, and we have to find the best way to make them the most amount of money, even though it may not be exactly how we would do it. But that's very interesting, and I think that's such a good point because for any of our listeners, right, that may say, well, I'm investing my own money or I'm putting my money with a manager, it's interesting for both sides, I think, to be open to what is the best way to to do this. And so that's super interesting. So you guys spent a good couple of years kind of pushing your strategy. It wasn't as well received as you had hoped. So you made some adjustments, and now it sounds like everything has kind of blown up for you in a really great way.
Yeah, exactly. We it's basically the same strategies. It's just that we've stacked them now on top of things that investors already want to own, instead of trying to fight with them about the fact that they should sell what they want to own to buy what they don't want to own, right? And if you ask an investor, hey, do you want to diversify your portfolio? Well, most of them say yes. But then you say, well, do you want to sell down some of your stock portfolio to make room for alternatives? They're like, I don't know, maybe I'll sit and watch it. What you say makes sense. I get it, but let me just wait and see, right? I think the stocks are in a really good position to move higher. I really like these stocks in the portfolio, blah, blah, blah. There's always sort of an excuse, right, to not take the medicine. So we're like, I get it. Don't take the medicine. We're just gonna be like the icing on top of the cake, man. Keep your cake. We're going to put some icing on it. In the end, you're going to get some diversification. In expectation, the portfolio will be more efficient, but you also get to keep what you feel is sacred and don't want to sell.
What a smart way to go about it. That's fantastic, because yes, there still is so much there's so much excitement out there about certain companies and certain stocks. And when you see things like Micron go up ridiculous amounts over a 6-month period, I think that misaligns expectations for a lot of people in a lot of areas of the market, right? Where, okay, what's going to be the next one that does that? And so, to be able to keep that exposure, I mean, I don't know if there's enough investors that think about not being correlated to the market, because everybody wants to be correlated to the market right now. It's going up. Why wouldn't you want to be correlated to that? But I'm old enough to remember 2022, and being correlated was not so good. And inevitably markets have cycles, and those things happen again and again. And so it's setting up that long-term approach, which I love what you've done in that space. That sounds super good. And I think it's also a reminder, traders and certainly fund managers and everybody, you want to be the person that buys that stock that nobody's talking about and nobody cares about and has very low volume, but you're going to get it and write it from $10 to $500 or whatever. But sometimes nobody's talking about it because nobody cares about it. And sometimes maybe nobody will ever care about it. And so, and so being able to kind of, keep your exposure, how you're doing it, while, adding that diversification and making room for the alternatives is a great idea. I love that. So tell me, you guys are, I was looking at the company's site, and you've got several employees and partners, it looks like. Who's really putting in the elbow grease on these algorithms and programming and testing? Are you involved directly in that? Do you love doing that?
I straddle a few roles. I am the CIO. There's a co-CIO in Canada, Andrew Butler, who happens to be my cousin, who's much younger and better looking than I am, and smarter,
I don't
it turns
believe
out. And so he does the real heavy lifting in terms of the quant work. He's got a master's in applied math, a master's in financial engineering, and a PhD in optimization engineering. So he does the real heavy lifting on the research side. And then we've got, a lot of this business is trying to find the right product market fit, right? Rodrigo came up with this idea of return stacking. He wrote a white paper in concert with our co-founder on the return stacking side, Corey Hofstein at Newfound Research. And that led to this entire new, very, very successful venture with the return stacked ETFs, right? Mike, manager of the business, leader of men, major inspiration, Bloomberg BNN celebrity, just unbelievable at getting the word out and, shepherding the company through several manifestations. And so, yeah, it's a team sport. There's no doubt about that, right?
For sure.
Sometimes I spend my time researching. Sometimes I spend my time writing. I wrote a book. I've written 20 plus, research papers at various levels of complexity. For a very long time, I wrote a research blog called Gestalt U, which then just transferred over to the investresolve.com blog. And now I write articles as well for the returnstack.com page as well. So yeah, you got to wear a lot of hats as an entrepreneur, as you know, right? And even in the investment business, there's time to focus on the investment research, and there's times to try to get the word out. And I do a little bit of both.
That's great. It certainly is a team effort. I've seen that very much on my end as well. And
what's your role, Jared? And I'm going to turn the tables on you because I run a podcast too. Say more about what you do and what your firm does.
Well, I'm also the CIO over here, and we have a hedge fund, and it's interesting as you say, your cousin up in Canada with a degree in applied mathematics. We have a couple of quants here that are applied mathematics people, and I think the question I have for you and the part that I'll share equally is, I have these quants, and there's so much, the intelligence is just oozing off of their skin. It took a while before we could understand what one another was saying. I was going heavy markets, so they were going heavy, quantitative analysis, and we have a beautiful marriage now. But But it's interesting, and I'm curious on your end. It's certainly been, with my quants, we've been able to really speed up and aggressively attack our development of models and algorithms with simple AI that has become available. These coding agents, Claude Code is like all of a sudden one person can do something that took a week in 5 minutes, and it's wild. And I'm curious, have you guys? I mean, I'm not firing anybody, but all of a sudden our efficiency is off the charts. I mean, has AI helped you guys just maybe on that coding side of things, been able to develop some of these algorithms a little more quickly?
Yeah, great question. There was a great deal of reluctance on our research and development team to use the AI tools when it first came out. I was just the most enthusiastic user of AI since GPT-4 came out. I remember I built some apps when GPT-4 came out that I had one child in the final level of the IB program, like an international baccalaureate program, kind of like the AP program in high school. And so I built an app that she could send her assignments to, and it wouldn't give her a new assignment or anything, but it would go get the rubric for that course and that assignment and pair it with her submission and ask her questions. What about this? How would you add this, or how would you think about that, or what have you? And then shared that amongst different people in my community. And I've been using it ever since, forever. Like just today, my AirPods Max, it hasn't worked for a while. I'm like, I'm going to plug it into my Mac and ask Claude Code to see if it could diagnose what's going wrong with it, right? So Claude Code downloaded some software, ran a bunch of diagnostics, and said, yeah, I think your battery's dead. Leave it in for like 15 or 20 minutes, see if it charges. But I've run all these diagnostics. I've asked you to run a couple of tests, press this button, hold it down, whatever. None of that seems to have worked. And then I asked you to find the closest, Mac credentialed service center, then write an email, coordinate with the service center to bring it in, et cetera. It did all that stuff for me, right? But I'll also have, we talked about restarting the computer because you're having some audio trouble before,
Sure.
Right? So I've got 3 long-term processes running in the background that I worked with Codex and Claude Code on to build these, GPU modules that I've deployed to modal.com, where I'm renting GPU space to run like multi-hour H200 runs, billions of net back tests, and, a variety of different experiments that there's no way that I would have known how to do prior to the, introduction of Claude Code and Codex, right? We were able to make a huge amount of progress on research prior to AI, but it, now allows us to scale our thinking in ways that just wasn't possible before. It's been really exciting. Now, there's some dangers and challenges with not being the one who writes the code line by line. You're abstracted from the experiments that you're doing, the data that you're doing. You're less likely to actually go in and look at the data than maybe you were before, or you don't have quite an understanding about what assumptions the AI has made as it's built the modules to conduct the experiments, et cetera. So there's actually a really steep learning curve, I think, in using these models for advanced research in any domain. And I think it really empowers people who were already experts in those domains to go a lot further. And it could be a little bit of a danger by providing the illusion of expertise to novices in a field who think that the AIs can sort of overcome the gap between, their understanding and expert understanding. Because there's a lot of rabbit holes the AI wants to go down, which are, ultimately very unproductive in assumptions, et cetera, that it makes that you may not know to inquire about, et cetera. I mean, does that jive with the experience of you and your team?
We have certainly seen very much the same thing. It's been very interesting for me because I have an extensive finance background, very light in the computer science, coding, programming space.
Mm-hmm.
I've always hired coders and programmers to do everything I've needed, and so I've kind of already had this intermediary coding agent. It's just been a human that's taken a lot longer to do what I needed to have done, and then has argued with me. And so I've actually found that I'm very well adept to working with a coding agent like Claude Code. I love Claude Code. And I think it's important for anybody that's listening, you have to argue with it. I'm used to arguing with coders. I'm used to arguing with programmers. This isn't what I want. Stop doing that. I don't care about that. Do this. Because exactly like you said, I've noticed this. I find myself arguing with AI constantly. I don't care about that. Don't do that. I know you think this is a great idea to go do that. Don't do that. And I'm constantly dragging it back. But you're right. There is this, I love when AI kind of started surfacing and everyone said, AI can do everything better than humans can do. And in theory, at some point in the future, maybe, probably. But right now, it's like you're handing a Ferrari to a 6-year-old and saying, go for it. And so you're exactly right. And I think what it has done is made experts in their field a lot more efficient. And it doesn't. Everybody's not a computer scientist now, and everybody's not a experienced investor now because they have AI. It's just it certainly is a way to speed up and make the process much more efficient. But there is a healthy disconnect between what the AI wants to do and what you want to have done, and it's been an interesting experience. I've certainly heard. It's gone from AI is going to replace all of us and everybody's going to become unemployed to you question the AI because it's not just, as humans, right? I sit here and I ask you questions, you ask me questions, we do all this. As humans, at the end of the day, there's something inside of us that, we want to be agreed with, right? And AI just comes at you and says, Adam, what a great idea you had thinking, to put this line of code in here. That's and you're thinking, and I'm thinking, thank you. You're the smartest thing on the planet. Thank you for, and then it's taking you down some other path. So it's certainly, inevitably it will change the world, but it's taking a very different path than I think the general public ever thought, and certainly the experts ever thought it would take. And so it still needs to be expert run. You still have to have the quants and the applied mathematics and the computer science, experts operating this stuff. But it sure speeds up the process. One thing I hated with my quants before, I would say, develop this, back test it. I need it before lunch, and they're like, that's going to take 3 weeks. And and now we can get it done before lunch. So it's it's exciting. At least kind of rough drafts of certain things. So it's very cool, but and it sounds like you've put it to work in your personal life, just with tasks here and there, and it's also been an important part of your investing development and approach, and so on.
Yeah, for sure. I mean, I also am like, I'm a bit reluctant to give that cautionary tale because. I can see how it sort of comes off a little bit as kind of gaslighting somebody who's using AI for investment research and is a little bit earlier in their journey, right? And it sounds a bit like I'm, well, yeah, of course I'll say that because I've got to protect my job, et cetera. And I get that. There's definitely like, conflicting incentives. And the other strange thing is that, I go into this in my own domain where I am a reasonable expert, though I'm still learning every day too. And I recognize how much guidance the AI needs from me in order to perform the experiments the way that I want them done, and not get sidetracked or not make dangerous assumptions, etc. And then I go to a task in a completely different domain where I'm demonstrably not an expert. But wow, do I ever feel like an expert in that domain? When I'm, and it's this Dunning-Kruger effect where, you know, you don't connect the dots between the fact that, wow, you realize how much of an expert you need to be to wield the machine in the domain you're an expert in, but you forget all about that when you move into another domain and then become vastly overconfident in what you're able to produce with the machine. So a cautionary tale.
Absolutely. I actually saw it was a super interesting interview, and I can't remember who's the name of the person, but it's an executive at Goldman Sachs, right? And they were saying, look, we no longer value knowledge because it's free and available. I mean, I could get a step-by-step how to do heart surgery on Chat GPT right now if I wanted to, and it would probably be great if I could actually do it, right? But chances are somebody would die, and I would say, it didn't go as I planned. But I think AI gives us this ability to, especially in the investing world, and I guess in everything, we have all this knowledge. It's easier to access now, and we also have a way to more easily apply it, right? And so with these coding agents and so on, we can take this knowledge, turn it into something, but there's still, that gap in between is still there. How do you know what this should be applied to create the positive outcome? And so I have loved watching it play out in the investment world, and how everybody, from the individual trader that's just trading their own money and going for it, to the institutional investor that's managing money for clients, which are very different approaches, right? You can't go to your clients and say, guys, we're down 30% this month. Sorry about it. We're gonna get you on the next round. It should be fine. But and so we have these very different approaches from the individual trader to the institutional investor and the money manager and so on. And I just think that there's so many more tools to be used, and it's going to be very interesting to see how this shakes out. And it's going to be very interesting to see how much, and honestly, if at all, the market changes. And I think this is, this is, I hear people talk about this a lot, and they say, okay, well, if AI is going to take over, and of course we've had, high frequency trading and algorithms in the market for a long time. It's not a Chat GPT or a Claude thing. This has been going on for a couple decades, right? And so how much has the market changed? Sure, there may be more volatility, dips may recover more quickly, but there's still a lot of human emotion behind everything, and there's still a lot of very humanistic traits that are observed in the market every day. I mean, do you think we're ever going to get to this point of this perfectly efficient market that has no emotional reactions to anything, and it's just very predictable because of all this technology? What are your thoughts?
No, I mean, I think we'd have to structure it completely differently than we do now, right? I mean, we structure the market more as a mechanism for entertainment and as a casino than we do for capital allocation at the moment. And it's, because it's become the de facto savings vehicle for the majority of the population, we can no longer really allow it to play the role of a market. I mean, markets go down. We allow companies to fail in markets. We allow price discovery, but that markets are such an embedded component, like it's endogenous to the economy now. And so we can't really let markets fall substantially or in a sustained way. And because when we do that, people can no longer borrow against their stock portfolio to consume, and they don't feel nearly as wealthy, so they're less inclined to consume. You've got companies that will go out of business because interest rates rise or spreads rise. People have their health insurance, their daycare, everything tied to their employment. everything is just tied to the corporate sector now and to the market in a way that it wasn't sort of 20 or 30 years ago. So, the market can either play the role of a virtually guaranteed savings vehicle for everyone, or it can play the role of capital allocation and price signaling, but it kind of can't do both. And I think we sort of made the choice of what we wanted it to play. And so now we live with that. And we've also got, as sort of part and parcel with that, we've got so much of the market is 401ks and, systematic, constant investing in indices, right? And that actually has very substantial impacts on the constitution of the indices, on the long-term profile of the markets themselves. And so it, again, pushes prices away from equilibrium or away from their natural price discovery point, and therefore further away from acting as a signal for asset allocation. So it's a wild and wacky world. The role of markets changes all the time, and therefore how you need to approach the investment in those markets changes over time.
So on that note, how would you view, has it been long enough since 2022 that everybody has forgotten that markets do go down sometimes? And how do you view the overall, because as you said, there is so much more kind of retail investing, and the pension funds have turned into, everybody's putting a portion in the S&P, an S&P ETF and so on. So do you think that a substantial downturn, maybe we have a bear market for a year? I mean, what does that do to the market? What is that? Do we just recover like we always do? Does that cause too much destruction? How do you see the next downturn? I mean, nobody knows when it'll be, but markets go up and down, right?
Yeah, I mean, this is my view. So take that for what it's worth. But I think for the reasons that we just discussed, I think, yeah, I mean, look, markets can drop like they did in 2022, whatever, 20, 25%, so long as you don't have a major uptick in vol, you don't have a major sustained inversion of the vol curve. And I guess what I'm really, and it's not accompanied by a major rise in credit spreads, right? What we didn't really see in 2022 was any major rise in the perception of default risk or growth risk. Rather, there was an inflation scare. And so, that's an unusual kind of bear market. It was, I guess, technically a bear market, but anyone who's sort of lived through the 2000 to 2002-3 bear market or the 2008 bear market knows that there's bear markets and there's bear markets, right? And I guess what I'm saying is, yeah, for sure, we could, the market could go sideways or be in kind of a 20% range for a few years. That's possible. The idea that the authorities are going to allow credit spreads to widen materially, or treasury yields to rise materially, or the S&P 500 to drop more than kind of 20-25% for a sustained period of time, I think that's very unlikely. And in the event that it does seem to be cracking in that direction, that we will see the Treasury and or the Fed step in, and where they bought kind of credit ETFs in the 2020 crash, I think they will be directly buying interest in equities in the next crisis period. I don't think politically that it's possible to allow the market to actually find fair value anymore.
Isn't it wild? Because I think that is, consensus at this point. Things are just gonna stay up, and these dips are recovering quickly, and they're getting bought like crazy. And we've already seen a light foray into the into the individual equities, and will that, from the US government, and will other countries follow suit and have their central banks buying into individual equities? And so it's going to be an interesting I mean, as always, right? I'm pretty sure since the beginning of the stock market, there's been something new that nobody expected that was ridiculous. And as long as step two past this next step is more creative, it's just hopefully we don't run out of the creativity and the resources in the market. You know, as we talked about in the beginning, the market continues to react to government interventions and so on, then we're in good shape. But yeah,
Well, it's just how much you need to sort of, it's the externalities that you're willing to tolerate, right? It's the currency dilution. It's needing to buy treasuries outright, and what that does to confidence in currencies. I think we will end up buying treasuries outright at the same time we end up buying stocks outright, and we will do that with legitimately printed money, and that will have very large impacts on currencies and very large positive impacts on stuff like gold, I think. But I've held that view for a while. When gold cratered there a few months back, I had a very large personal gold position on, and when the market told me that trend was at least ending in the intermediate term, then I sold it. Am I ready to go back in when I see the trend resuming in my pro account? Absolutely. But ultimately, the price action governs what I believe, and I don't believe I'm smarter than the market. So you've got to be flexible and ready for anything.
It's both a very enlightening and also sadden. It's a sad day when you realize the market doesn't care what you think. And I
Right.
still remember when I learned that lesson. I thought, man, but also great, because now I'm not continuing to go through the painful lessons. And so you do have to, I mean, one thing I kind of always remember thinking to myself is I can't invest what I think. Eventually you have to kind of trade what you see. What is, if Nvidia is going straight up and never stopping, do I want to short that? Probably not.
Right.
And so you got to get on track with it. But that's great. I have loved our discussion. I think there's so many good takeaways from this, and I'm sure that my listeners will be excited to follow your journey and continue to keep up with what you're doing and publishing and so on. We'll definitely post the links, but just give us a quick mention of where everybody can find and follow you.
Yeah, for sure. So I'm on Twitter. I'm Gestaltu, Gestaltu, and I publish to investresolve.com and returnstacked.com. And I'd encourage you to check out all of those different properties and reach out with any questions.
Excellent. And we will definitely post those links with this episode so everyone can keep an eye on it. But that was great stuff. I really appreciate your insights and being on with us. And, I always love to invite good guests back. And you've been a great guest. So I appreciate it. And we'd love to have you on again in the future.
Thank you very much, Jared. Really appreciate the questions and the conversation.
Thank you, Adam.